Well, let's talk about dividend investing. I know we talked about that at the top of the show. You guys have been very active on YouTube talking about how this can be an important way to build up your financial independence or your passive income. So break things down for us a little bit. What is dividend investing?
To me, I would say that dividend investing is more of a, think of it as buy and hold investing, right? And it's the only way for you to really make truly passive income in the stock market. Where else can you just take your initial payment and then sit back and get funds coming into you? That's passive. I don't have to do anything else but sit there and wait for it. All I'm doing is holding that security.
The company you invest in, they have to work for it. They have to get a new project, do new things to earn that money, but you are getting that money just for holding the stock. And it's a long-term buy and hold strategy where I think the misconception that a lot of people think is that the way you make money in stocks is to buy low and sell high. And it's not the only way to do it. And it's not the safest way or the easiest way to do it. The easiest way to make money in the stock market is to do income investing, which is dividend investing. Focus on buying stocks for the income that it can provide. That is dividend investing.
Got it. So talk to me about the difference of the two avenues that I guess can grow with the stock. So we've got the stock price that can grow and then the dividend itself. Can we talk about the two differences there so people understand?
Okay, so they're both, it's actually, I like to call it a triangle. It's my little coin, DPE triangle, okay? Because the part that a lot of people don't focus on is that they're all tied to earnings, okay? Dividends and price are both tied to earnings. So you want a company that's going to grow, because if not, there's no reason to buy a company. That's why the price goes up. People are expecting that this company is earning and they're going to make more money, and therefore it's a valuable company. Now, if a company does not grow as quickly as it should, the company has to give you an incentive to buy its stock. They do that through dividends. Dividends is a way to incentivize buyers to buy a company that's still a good company, but can't compete with another company that's growing at such a trajectory that they can't grow anymore because they're in a different stage of their life cycle.
They're more mature companies that will do that.
So that's how dividend and price. So you want to buy a company where a dividend is stable and growing. And if you can, the price is also appreciating.
That's like fantastic.
Yeah. So they're all part of, and they all are at the end of the day tied to the earnings of the company, because a healthy company will have healthy earnings, and the dividends are coming from the earnings of that company.
Got it. Well, you two are all about keeping things simple, right? So how does somebody find a good company like that without pouring through the numbers and maybe not really knowing a lot about all of that detail? Well, what's a way that the everyday Joe could do that?
Yeah, I'm going to tell Nicole to make it very simple.
Yeah, Nadia tends to say, Nicole, you're going off, but okay.
No, I like the triangle. The triangle was,
okay.
the triangle was good.
Yeah, good one, right?
I like that.
So now when it comes to a good investment, that's kind of like, it could be a loaded term, what's good, right? Because it's relative to one person to the next because it's based on risk tolerance. But to keep it simple, the first thing you should do if you know nothing about stocks or dividends is to look at what products do you have in your house. Let's just keep it basic. Do you have Coca-Cola in your house? Do you have something from Procter & Gamble in your house? Do you have something from, I don't know, Target in your house? Okay? And you say, okay, this is a company I have in my house. This is a company I know. So the first thing you should do is focus on companies you know.
And understand.
And understand what they're doing to make money. Okay? Then you can then research to see, is that company a dividend paying stock? And you can do that by going to Yahoo Finance, Googling it, or going to the actual company's page. After that, the second step you want to think about is dividends. So, you pay dividends. Is it paying dividends? And what are these dividends doing? Did they cut a dividend recently? Or is the dividend stable? Or is the dividend growing? Okay. The third thing you want to look at is the yield. The yield, which a lot of people make it very complicated, but just think of it as the income you receive for holding the stock. And when you think of it as just income and just don't say dividend yield, just say yield, you can then compare it to different options, right? A savings account is a place where you can put money and get a yield of, say, 1%. That's a safe investment that you won't lose your money, but it's not yielding much. If you want something higher, you need to go into stuff like stocks, bonds, things of that nature. So the yield of a stock, you want to benchmark it against the yield of a savings account. That will tell you how risky it is and how much of return you can expect by putting your money in there.
How much income?
How much income you can expect by putting your money in that rather than putting into a savings account. So that's a risk tolerance, because you have some stocks that are giving you, 7%, 10%. But what do you need to give up? What risk are you putting in there to get a 7% return? Because it's very high over a savings account.
Sure. When you say 7 to 10%, is that the growth of the stock itself as well as the dividend?
That's the dividend yield.
Just the dividend yield. Okay.
Just the dividend yield. You can actually look at stocks and compare them just based on the dividend yield, which you can find the same place you find a stock on Yahoo Finance and even on the company stock page. It will tell you if it's a dividend stock, it will tell you the dividend yield of that stock.
Got it. So you said that when you were doing your 401k, you got into index funds because it was simple and easy. Is there anything the equivalent of an index fund for dividend investing with the stocks that you're talking about?
Yeah, actually, dividend investing can be done with single stocks, index funds, and ETFs. Vanguard is a great place. Fidelity, they all hold dividend index funds. And you can just type in dividend index funds and you will find them.
Got it. Yeah, we've talked about the benefits of index funds on the show here, as well as just having the simplicity of them and just making it a little easier, because the searching and the making sure the company doesn't go bust, situation of certain stocks can make people feel uneasy. But to your point, I think your point was find companies that have been around for a while, that you use, that you know a little bit about, that don't feel intimidating, and then it won't be as, I guess, confusing. Is that right?
Well, yeah, but on top of that, you can still do that same thing and invest in index funds. So let's go back to example Coca-Cola, right? You can buy Coca-Cola as a single stock, but Coca-Cola is also one of the companies you can buy in the SPY ETF. And it's also part of an index fund. I don't know off the top of my head, but you can buy Coca-Cola in different ways. You can buy an index fund that has a portion of it to hold a portion of Coca-Cola, just like you would buy Coca-Cola outright. Yeah. So you can still buy something but take away some of that risk and all that research you have to do by lowering the amount you own of it through the diversification that you find in an index fund. Am I getting too complicated?
No, I think that's fine.
Okay. That makes sense. So would the yield be a bit lower then if we were looking into an index fund, because the growth opportunity would be higher?
Yeah. So right now, Coca-Cola by itself has a dividend yield about close to 4%, right? But say SPY, which holds a portion of Coca-Cola as part of its holdings, I think the last time I checked was about 1.9%. So you're going to give up some dividend yield, but you're going to take away some of your risk.
Got it. Okay, that makes sense. No, I think she did a pretty good job, Nadia. Absolutely.
Thank you, Andy.
That is coming from a money nerd that just eats this stuff up. So I guess it's depending, and I guess a lot of people who are listening to the show are a little bit money nerdish too. So, so how can somebody eventually live off of dividends? How could that be possible? I mean, that's true financial independence, or it feels like financial independence to me, where that's just having the money come and you're just living off it. How does that happen?
So, like we said before, it's a long-term buy and hold strategy. So you also have to invest a lot to it, because these dividends are quite small. So you have to have a lot of shares in these companies.
Like $2 and $5 here.
It's not like $100 dividend every month. So it's a long term, and you want to build up the portfolio. So in order to live off of just dividends, I was, thinking of some number. Let's say, I don't want to scare people with such a number like $1 million. Let's do $750,000 you have invested in dividend stocks. We're talking over a 20-year time period, right? Or however fast you can get that $750,000. Dividend stock portfolio that's yielding 5%. Okay, it's not that crazy. It can be done. 5%. That means 750,000. Let's make it. That's 37,500 a year. Okay. Now have you heard of the 4% rule that the fire guys like to use?
Yeah.
Okay, let's live off of 4%. 4% off of 750,000 is actually 30,000. Okay, this is 30,000.
Yeah.
Nadia, she doesn't like my math, but you double
Close
check
enough.
my numbers if you like,
do.
right?
I think it's about 30.
Okay, but
So
it's
you're
below.
making
It's
5%.
you're making
but
5%. You're only taking out 4%.
Got it.
Okay, so one, you're not touching your principal, the 750,000, and you still have some dividends that you can have reinvested. But you can definitely live off of 30,000 based on the lifestyle you want. So whatever the lifestyle you want, you have to figure out what that is, and then see what you need to be able to live off that number with just dividends.
Yeah. Let's talk to the person who's saying, well, that sounds really nice to have $750,000 or $1 million. That's going to take me forever. Can we talk about the steps that maybe would happen before that? Wouldn't it be nice to have $10,000 extra permanently to live off of to pay your whatever, your mortgage or your property taxes every year? I mean, are there steps along the way that can encourage people to see this as a lifestyle choice?
Well, if you're just starting out and you don't have a lot of money to put away and start dividend investing, we just made a recent video about this, but I think people should look into fractional shares, right? Because you can purchase a ETF or dividend paying stock as a fractional share. And that way you're using a little bit of money, but you're also being paid a dividend based on the amount of that share you own.
So what is a fractional share?
It's a fraction of a share.
Fraction of a share.
There you go. See, sometimes they have these big, complicated words, but you break them down, they're not that complicated.
Yeah. So, like, say, here's an example. Amazon is not a dividend stock, but you can buy one share Amazon at $1,900, or you can buy a fraction of one share for, say, $5. It'll be a very small fraction, but yet you will own Amazon. Now, you can do that with ETFs. You can do that with dividend paying stocks.
Yeah. That's why I get a lot of young people start getting interested in and say, oh, I don't have any money. Well, you can start off with little as $1 or $5 and start getting into some quality companies that do pay a dividend. So you do make a little bit of interest off of the money that you're putting into the stock market.
And then when you see these little, paychecks coming in, you're like, wow, this is great. And you can start putting money aside, take $5, $5, and don't just invest the $5. Get it up to 100 and then invest that 100. So you want to just have whatever you do, you want to make it consistent. And as you get older, hopefully you'll be making more money. And as long as you keep that consistency and you build up the amount that you're investing, you'll appreciate it. Yeah. You'll be surprised how fast it goes.
Which brokerage firms do the fractional shares?
A lot of them are pushing it out now. Not everyone, but like Charles Schwab does it. Fidelity does it. Stockpile does it. I think Robinhood does it also.
They're getting close to it.
But
M1 Finance does
Vanguard does not do it, I believe. Vanguard doesn't do fractional.
So some of the newer guys coming in do it, and then now the bigger, older brokerage houses are doing it. So yeah. Charles Schwab just released it in June, and actually Fidelity released it earlier this year.
Yeah, what they're trying to do is entice the newer generations to start investing. They're dropping their fees, and there's like, oh, you can do stock slices or fractional shares at this point.
It's a great time to invest. It doesn't take much money, and it's a great habit to develop.
That's great. That's great. Well, let's say there's somebody listening right now that says, hey, I've got a good amount of debt though. Should I be investing right now? Should I try dividend investing, or should I pay off that debt first?
That's more probably a personal answer, because how does that debt make you feel? Does it keep you up at night? Are you always thinking about this debt? If that's the case, maybe it's better for you to pay off that debt first before you start investing, right? Mm-hmm. And if that debt is at a high interest rate. But if you're borrowing money, say it's on a mortgage or whatever, and the rate is very low, under 3% or 3%. Well, now the new mortgages, you'll probably get under 3%, which is fantastic. But that basically, to me, it's free money. So why pay that off early? If you can, invest at the same time you're paying that debt.
And make more, over 3%.
Yeah, make more than 3% on your investment. Or like pay the debt as you can, paying it off as a normal basis, but like funnel some money into investing. Do both at the same time. It just depends on the person, how you can tolerate the debt that you have in your life.
We don't see it as an either or. We don't think you should really, we love paying off debt. We tell people pay it off, but we don't want you to have your past really affect that much of your future. Because no one would ever tell you, don't put into your 401k if you had debt. So it's the same thing. We're not telling you to do speculation type trading where we're saying buy low, sell high. We're telling you long-term buy and hold strategies.
Yeah, and the quicker you can get in, the better it is for you, because you benefit from compound interest.
And that's why I wanted to have you guys on.
Thanks.
Well, somebody's listening right now and they are motivated by what you guys have done with your lives, as well as this whole idea of dividend investing. What is the first thing they should do following this interview if they're interested?
I would say one, I mean, we kind of talked about it with financial independence and dividend investing. I would say first, learn your FIRE number, which is something you can look up. Is just, what is it 25 times your yearly expenses? The reason I like the FIRE number, even if you don't want to use it to retire early, it means financial independence, retire early number. Even if you don't want to use it to retire, it gives you a number that you can use as a target to say, this is how much I want to have saved up. And I think having that number makes this more realistic. I think the problem is with a lot of people, they go, oh, I need millions to retire, or I need this. If you have a number, it becomes more real, and you can use it as a target to hit. Then once you know your FIRE number, start looking more into dividend investing and different avenues of how you can get to that passive income number that you want, and also how can you get to your FIRE number.
Yeah, I think a lot of people get intimidated when people say, oh, FIRE, I have $1 million. It all depends on what your yearly expenses are. You can really control that number by dropping your expenses. You can live in a lower cost area. You can
live overseas.
That number is dependent on how you want to live your lifestyle. And then you can use dividend investing to bring money in to help you bring yourself closer to that number.
I love it. I love it. Yeah, control your expenses and then make a plan to where you want to go and invest to get there. So that makes a lot of sense. Thank you both so much for your time. I've really enjoyed your YouTube channel. I've really enjoyed checking out your blog. So where is the best place for people to connect with you if they want to learn more about what's going on with the WealthTwins?
Well, I think the best place you can connect with us is on our YouTube channel. It's youtube.com/WealthTwins.
We do weekly videos.
And you can also hit us up on our blog at WealthTwins.com.
We answer every comment. We answer every question. And we would love to see you guys.
Excellent. I can attest to that because I've been commenting and they've been writing back. Nadia and Nicole, thank you so much for your time today. I really appreciate it.
Thank you, Andy. Thank you for having us.